What if your money could work for you, even while you sleep? Not through some get-rich-quick scheme, not by gambling on meme stocks, but through one of the oldest, most reliable wealth-building strategies in the history of the stock market. We're talking about dividend investing. And if you've never heard of it, or you've heard of it but don't know where to start, this video is going to change the way you think about money. Welcome to Global Finance Watch. I'm going to walk you through everything you need to know about dividend investing as a beginner, what it is, why it works, how to pick the right stocks, and exactly how to start building your own passive income machine. Let's get into it. Let's start with the basics. When a company makes a profit, they have options. They can reinvest that money into the business, buy back their own stock, or they can share a portion of those profits directly with their shareholders. That payment is called a dividend. Here's a simple example. Say you own 100 shares of a company, and that company pays a dividend of $1 per share every year. That means you receive $100 in cash, just for holding the stock. You didn't sell anything. You didn't do anything. The money just shows up. Dividends are typically paid quarterly, 4 times a year. Some companies pay monthly, a few pay annually. But the key point is this: you get paid simply for being a shareholder. Now here's where it gets interesting. There are a few important dates every dividend investor needs to know. The declaration date is when the company announces the dividend. The ex-dividend date is critical. You must own the stock before this date to receive the payment. The record date is when the company confirms its list of shareholders. And the payment date is when the cash actually hits your account. Miss the ex-dividend date and you miss the payment. So timing matters. Now, you might be thinking, okay, a few dollars here and there sounds nice, but can you really build serious wealth through dividends? The answer is a resounding yes, and the data backs it up. Here's a stat that stopped me in my tracks when I first saw it. According to Hartford Funds, 85% of the cumulative total return of the S&P 500 going back to 1960 can be attributed to reinvested dividends and the power of compounding. Let that sink in, 85%. And from 1940 to 2025, dividend income accounted for an average of 33% of the total annual return of the S&P 500 every single year. This isn't a minor footnote. Dividends are a core engine of stock market wealth creation. The investors who figured this out early are the ones quietly getting richer, while everyone else is glued to daily price swings. Here's why dividend investing is so powerful, especially for beginners. First, income without selling. With growth stocks, you only make money when you sell. With dividend stocks, you're generating income continuously. That means you're not forced to sell at the wrong time. Second, it rewards patience. Dividend investing isn't a fast money game. It's designed for people who think in years, not days. And that patience is exactly what creates real wealth. Third, it filters for quality companies. Companies can't consistently pay and grow dividends unless they're genuinely profitable and financially stable. The dividend itself is a signal of business health. Let me put it this way. If you invest $10,000 in a dividend stock yielding 4%, you earn $400 in your first year. If you reinvest that and the company raises its dividend, which the best ones do every single year, that number starts to compound. Give it a decade and the math becomes very exciting. Before we go stock picking, you need to understand the key numbers, because not all dividends are created equal. Some look great on paper and are actually traps. Let's break down the 4 most important metrics. The first is dividend yield. This is the one everyone knows. Dividend yield tells you how much a company pays in dividends relative to its stock price. It's calculated as the annual dividend divided by the stock price. So, if a stock costs $100 and pays $4 in dividends per year, the yield is 4%. Here's the critical thing beginners get wrong. A high yield isn't always better. If a stock's price has crashed and the dividend hasn't been cut yet, the yield looks artificially high. That's called a yield trap. We'll talk more about avoiding those. A healthy starting range for most beginners is somewhere between 2% and 5%. The second metric is the payout ratio. This is arguably more important than yield. The payout ratio tells you what percentage of a company's earnings is being paid out as dividends. If a company earns $1 per share and pays 50 cents in dividends, the payout ratio is 50%. That's healthy. The company has room to sustain and grow the dividend. If the payout ratio is 95% or 100%, red flag. There's no cushion. One bad quarter and the dividend could get cut. As a general rule, look for payout ratios under 75% for most industries. The third metric is the dividend growth rate. A company that raises its dividend every year is sending you a powerful message. We are confident in our future. We're growing. We're committed to rewarding shareholders. Look for companies with a consistent track record of dividend growth, not just a single high payment. The fourth is dividend history. How long has this company been paying dividends? Have they ever cut? The longer and more consistent the track record, the more reliable the income stream. Which brings us to one of the most exciting concepts in dividend investing. Let me introduce you to the elite club of dividend investing, the dividend aristocrats. These are S&P 500 companies that have not only paid dividends, but have increased their dividend every single year for at least 25 consecutive years. No freezes, no cuts, no exceptions. As of 2026, there are 69 companies on this list, and they represent some of the most recognizable names in the world. Take Coca-Cola. Over 64 years of consecutive dividend increases. Think about that. They've been raising their dividend through recessions, market crashes, global pandemics, and everything in between. Or Johnson & Johnson, 63 years of consecutive increases. A healthcare giant that's been mailing bigger checks to shareholders longer than most of you have been alive. These aren't exciting, high-flying tech stocks. They're what I like to call boring wealth builders. And boring, in the world of dividend investing, is exactly what you want. Now, beyond the dividend aristocrats, there's an even more exclusive group. Dividend kings. Companies with 50 or more consecutive years of dividend increases. We're talking about companies like Procter & Gamble, 3M, and Colgate-Palmolive. These businesses have survived everything the economy has thrown at them and kept raising their dividend through all of it. When you're building a dividend portfolio as a beginner, these lists are a great starting point. You're not guessing. You're building on decades of proven performance. Here is the single most powerful tool in a dividend investor's toolkit, and most beginners either don't know about it or don't use it. It's called DRIP, the Dividend Reinvestment Plan. Instead of taking your dividend payments as cash, you automatically reinvest them to buy more shares of the same stock. More shares means more dividends next quarter. More dividends means more shares. And this cycle compounds on itself over time in a way that's genuinely hard to fully appreciate until you've watched it happen. Let's look at a quick example. Say you invest $5,000 in a dividend stock with a 4% yield. In year one, you earn $200 in dividends. You reinvest. Now you've got $5,200 worth of stock earning dividends. Year two, your dividends are slightly larger. You reinvest again. Year three, even larger. And if the company raises its dividend by 6% a year, which many of the best ones do, the compounding accelerates. Run those numbers out 20 or 30 years, and we're not talking about pocket change. We're talking about a seriously meaningful income stream. Most major brokerages, Fidelity, Charles Schwab, Vanguard, offer automatic drip at no cost. You just turn it on and let it run. That's it. No daily decision-making, no market timing, just consistent, compounding growth. Now, let's save you some money by covering the mistakes most beginners make. Mistake number 1, chasing high yields. We touched on this earlier, but it's worth hammering home. If a stock is yielding 10%, 12%, 15%, ask yourself why. Companies don't just give money away. A yield that high usually means one of two things. The stock price has tanked, or the dividend is about to get cut. A cut dividend is devastating. Not only does your income drop, but the stock price typically falls hard on the news. Don't chase yield, chase quality. Mistake number 2, not diversifying. Putting all your dividend income into one company or one sector is a real risk. If you're loaded up on energy dividend stocks and oil prices crash, your entire income stream takes a hit. Spread across different sectors: consumer staples, healthcare, utilities, financials, industrials. Diversification isn't just about reducing risk. It's about keeping your income reliable no matter what's happening in any one part of the market. Mistake number 3, ignoring the payout ratio. We covered this in the metrics section, but beginners consistently overlook it. A company paying out more than it earns is not sustainable. Check the payout ratio before you buy. Mistake number 4, giving up too early. Dividend investing is not a get-rich-quick strategy. In the early years, your dividend income might feel small, maybe $20 a month, then $40. It can be tempting to abandon ship and chase something flashier. Don't. The investors who got rich on dividends are the ones who stayed patient. Year 5 looks different from year 1. Year 15 looks completely different from year 5. Play the long game. You've got the knowledge. Now let's talk about actually building your portfolio. Step 1. Open a brokerage account. If you don't already have one, look at Fidelity, Charles Schwab, or Vanguard. All 3 are beginner-friendly, low-fee, and support automatic dividend reinvestment. Step 2. Start with ETFs if individual stocks feel overwhelming. Dividend ETFs like VYM, that's the Vanguard High Dividend Yield ETF, or SCHD, the Schwab U.S. Dividend Equity ETF, give you instant diversification across dozens of dividend-paying companies in a single purchase. These are excellent starting points. You're getting instant exposure to high-quality dividend payers without having to research individual stocks. Step 3. Add individual stocks over time. As you get more comfortable, layer in individual positions from the Dividend Aristocrats list. Focus on companies you understand, with strong brands, consistent earnings, and a history of dividend growth. Step 4. Turn on DRIP. The moment you buy your first dividend stock, turn on automatic reinvestment. Let the compounding begin. Step 5. Invest consistently. The most powerful thing you can do is invest a fixed amount every month, whether the market is up or down. This strategy is called dollar cost averaging, and it means you buy more shares when prices are low and fewer when they're high. Over time, it smooths out your cost basis and accelerates wealth building. Step 6. Review, don't obsess. Check your portfolio quarterly. Look at dividend growth, payout ratios, any changes in business fundamentals. You don't need to be glued to it every day. That's the beauty of dividend investing. It works in the background. Here's the bottom line. Dividend investing isn't glamorous. It's not going to make you rich overnight. But it is one of the most time-tested, consistently powerful ways to build real, lasting wealth and genuine passive income over time. The people who figured this out didn't wait for the perfect moment. They started, they stayed patient, and they let compounding do the heavy lifting. So whatever amount you can invest, whether it's $100 a month or $1,000 a month, start. Turn on drip. Be consistent and let your money start working for you. If this video helped you, hit that subscribe button. We put out new finance education and market insights every week. And drop a comment below. Are you already investing in dividends? Or is this your first time learning about it? I'd love to hear where you're at. I'll see you in the next one.